analysis part 2. If you see a cat sitting here disappearing, that's just one of our brands here. We do a lot of things here at Jacobitz Learning. So thanks for coming. All right, so anyway, here's stock market realities. We went over this before. Show overall genders. Okay, let's take a look at a real portfolio here. And again, we don't show the name of the actual platform used, nor the stock, nor the company. We're just going over right now total numbers. So I want you to think about these quantities here, that this is really only 15. Please don't think that's 15,000, 115 like they do in British. This is 22. And they just put this here, I guess, because the dollar amount's there. This is 6. This is 12. This is 100. This is 2. And this is 85. Now, this here is the actual price. $17.33, $14, $116.25, $13.81, which is what it will be, the price at which it will be calculated. It's not going to be rounded up to 14. Okay, they're not going to do that. This is really $13.81. That was the last price it was quoted. This is $10.32, $2.50, $56.78, and this is $1.93. Okay, so here's another look at what we're doing. Just wanted to show this to you because when you look at these numbers, there's an old saying, actually, liars figure, but figures don't lie. So let's take a look at what these figures actually do. That this 15 shares at $17.33 went up 9 cents. But then how do you have a $950 loss? Well, that's a total loss over the entire price of the stock. Okay? You all know I don't write well, so you're used to. It's $2.61, 94 cents. Last price. This is the last bid and last asking price. We're doing this video on Saturday, so this closed yesterday at 4 p.m. because we did this on an American stock. Okay, the reason I say that because there are other stocks. There's like Forex stocks. There's like all kinds of other exchange companies, Nisei market, Japanese stocks. This is based on American stocks. So anyway, and again, $22. 22 shares. I didn't mean dollars. $14.13 overall gain. $7.75. $309.79. Look at this. You know how you're in math and back when you were in middle school, elementary school, and they said 14 times 22. Or would you rather do 17 times 15? Well, see, here's how your numbers come up. But here's the thing. Also, this $14 went up. It went up 4 more cents. And when it went up 4 more cents, you had to go up $7.75 per share, and you got this price, $309.79. So you look for things like that too, like how much it is going up. It's going up 13 cents here. It's going up $9 here. What really happened? Like, what's better? To start, at a lower price, or to start at a higher price. And in general, you want the stock to go up. So if you're buying stock that is now $1,961, and it's not going to do what Bitcoin did and go up to 16,000 or 2,000, you're going to find yourself in trouble. So you're going to try to buy as low as possible. There's 2 shares at $116.25. Some of you know what this is if you just, go on the market and see what it went down, $1.90. This stock has been around for like 20 years, $12.82. This is a high price to bid. That's another thing. But the stock was purchased because it's an old stock. It's a company that's been around 20 years or more. This company, has been around 20 years, and put a check by all the companies that have been around 20 years or more. No, this one hasn't. This one hasn't. This one has, but it had some volatility. We'll go over that. And the rest of them kind of are 2 years or more. This one here is about 10 years, and this one here is 5 years or less. So let's look at these, and let's also take a look at this real quickly. 12 shares, excuse me, at $10.32. 12 times 10 is what? Shows up over here, but it had overall loss of 26, overall gain of 11. Look at this, no gains, no losses. Once had a broker tell me penny stocks are not the best. Why is it called a penny stock? Because it's sold for almost pennies compared to most stocks, and also it's under $5. Some people consider a penny stock to be under $1, but it's under $5, so it's a pretty low selling stock. There are 100 shares, but look, there's no movement. And there hasn't been movement for weeks. So it's just staying here. Now, the good thing is it's not going down. Okay? So it didn't go down. So it has a chance, but it's not doing anything at all. Okay, so you're just staying there and it's holding. It's really not losing money. It's not making money. Okay, most people do not like this kind of stock. They either want the stock to go up or down so they know that it's what they call live and it's still moving. And if it's lower, they're going to try to sell it. And if it's higher, they're going to keep it. Okay, that's a general rule. Okay, here's $3.48 here, but here's $2.93. Overall, this is a day's change. This is your total loss, because total loss means over the time you've had it. Total loss or total gain. It's a gain if it's in green. It's a loss if it's negative. 85 shares, 193, goes down 1, but over time went up $14.48. Isn't that a great share? So we're just looking at this sheet right now, trying to get you to look at what's going on. And also, these are your dollar value amounts. Start adding those. Start adding all these boxes and see what they come out to, because that's how you can build shares slowly over. But you can look at this 261, 309 has to be like 550 plus 232 has to be 750. This added on 8, 9, 11. We're rounding up 12 and 1. You'd have over like $1,224, and when you actually add it, it's $1,454. So this is not bad at all in between your changes and for what amounts you bought them. And remember, the highest was $116 per share, which is very high. Next one was $56.78, and then the rest were for under $20. Okay, and let's say this. These are not guaranteed. These are not where you sit in the bank and it's going to go up or down. The bank says, hey, you lost and we're going to give you a dividend charge. These dividends only come if the company decides to, or if they have a certain amount they have to pay you. Okay, speaking of, let's look at another stock. Here you have current net asset value. Okay, that's how much this particular asset, and could be a stock, one stock, or it could be a mutual fund, which pools of stocks. Net asset value. Okay, and this was the previous 12.92, so that's just 5 cents. And that's right here, that's your change. Total market value 1,647.5 shares. Okay, so if you add, and usually you're supposed to round up. So if you did 1,648 shares multiplied by whatever price these were purchased at, this is what, I'm not quoting the price they were purchased at. I'm quoting at what it's worth now. Um, we can go over that in the next slide. This was dividends. So this is money paid out to you, and this year would have been 2022. Okay, so capital gains long term were $621. A lot of people will say, yeah, but there are tax consequences. You have to pay taxes on that. Well, you pay them in relation to losses you have on other things, and a lot of people um, also inventory other things. Like if you're a teacher, you inventory uh, supplies you brought for your class, and if you are business person, you have other losses if you wanted to balance this out, but that's for you and your tax attorney. That's for you to go over with Hewitt, Liberty Tax, and or HR Block, okay, or whoever you use. Okay, your uncle, your aunt, whoever is a tax attorney. So this was only paid one time. Okay, and on your tax form, you'll see this amount. Please don't think that this is double. When they add this, they're adding your dividend plus your CG. If this were a loss, they would deduct it, and this would show up something altogether different. So that's another thing you're looking at when you're dealing with stocks. What's going on overall, that you have a market value of $21,000, $369. You can say in 15 cents, but I'm rounding down. And you also got a capital gain, but you got dividends. And while you have to report these, like when dividends are paid out or if they're reinvested, they can go back into this amount. We can have them paid out to you. So if you were doing this like quarterly and you had a car note that was $315 or $300 or $400, you could, take your dividend and pay off the car note. Capital gains sometimes don't get paid out till the end of the year. Okay, this would be part of your Christmas money. So that's what you're looking at, how you can make money work for you. Net asset value of 22.97. And you see that the previous net asset value was $23.01. You had a 4% change. That's how much it went down. So ask how these shares went down at this level. Okay, now the original share was $27.60. Okay, that was December 2021. The original total cost of the shares were $292.19. So if you really divide that closely and look at what happens, obviously the person had to have what they said 10.5 shares, 10 and a half. So that's what they had. That was multiplied out. This was done for you. This shows up in your statements too. And these statements are online. If you want them to be mailed to you, they can, but a lot of people are doing online. So currently, as of May 19th, the current net asset value was $22.97. Previously, it was $23.01, so it went down as we went over 4 cents. But here's the situation. Along the way, you had some capital gains, which means which means that pretty much you had a short-term capital gain. Some companies will do that. And then you had a long-term capital gain. And pretty much what had to happen is you had to have a spread at some point. When I say you, the person whose stock this is, we have permission to use this person's stock, between $27.60 and it going down over the last year and a half. To basically $4.60. Somehow there was a spread. Now, here's the next question you want to ask. How does something like that happen? Because it's almost impossible to think about that if a price is dropping, price went down, you still made a capital gain. Well, let's look at that on the next slide. Okay, so the question on the last slide was how does something like this happen? How can you get a capital gain spread, short term of $3.64, long term gain $422.01, and then get total capital gains of $425.65? Well, while the price is dropping, that's yet another thing. Okay, here's what's happening. This particular stock belongs to a class of stocks that made a mutual fund. I want you to look at all this. These are all the caveats I want you to look at, because if you were to email us or call us, we really can't guarantee that this will happen to you. And remember that this started back in December 2021. So we can't guarantee another company. And I'm sorry, we're not responsible in any way if you go out and invest in stocks and you don't get these same spreads, because we're talking about specifically what could happen. This is a conditional scenario. Okay, all the rest of this is up, and I'm sorry I can't tell you the name of this fund and exactly what it is. Maybe in the next videos we can give out some funds that we invested in, but most of our investments did not spread within like 6 months. These are things that went on over a gradual period over years, because we're now in May 2023. Okay, so this was the prior year, which again was 2022. We don't even know if we're going to get mutual funds or capital gains. Actually, they will write you like in April and say you're going to get a capital gain. We put that we were going to have them reinvested. So, and when I say we, it's really not the Jacobitz Learning so much as it is one of the owners in here. So they get reinvested. They don't show up in an account. Sometimes they will send them back to you in a checking account, sometimes not. But sometimes they will send them in a checking account, sometimes not. But what also happens is a lot of people don't get to have their money come to them at these levels. Another thing, if you increased your shares and you went over here to 1,444 shares last year, would this spread have been greater? Like, would it have moved incrementally? Well, that depends on the percentage of your shares, so you don't guarantee that. But you can just sit here and think that, of course, you're going to get more of a spread if you invest a little bit higher. Okay, so this spread would have actually been higher if you invested in more shares. Okay, to how much more we cannot guarantee, but this is just showing you or role playing a simulation of what could happen if you watch what's going on day to day. And if you start at 1 year, come on, $27.60 times 10 shares. Basically, you need $292. Why do you need the extra? Because there's something called a fee. And the firm uses a fee and they tie it into something called a cost basis. That's how much it costs them to hold this money or reinvest it for you. So when I started out doing this, a lot of people said you don't want to spend too much in fees. Okay, because if you spend like $34 per share, and think about it, if you do your math, $10.58 times $27.60, okay, should come out to $292.17. So basically, there was a fund fee that was like zero. Okay, $0, 2 whole cents. And companies are required to disclose this. So if you were at 0.02 of fund fee, and this is what happened to you, and you got a capital gain, got a spread, no dividends, you're really not losing. Okay, think about that. Here's yet another question. This is the present value found here of $21,286.77. Okay, present value. Okay, and here's the market value. One's higher, one's lower. So market value, because when these were purchased, they were purchased at a lesser rate than what they're worth now. So that means this owner has a higher market value here than actually what they're worth because of when they invested. It's just $100 so dollars. You can go ahead and do your simple math. Excuse me, $369.15 minus $286.77 is only $82.38. So in terms of you haven't lost or haven't really done anything or gained anything, so it's really not such a big deal. But at the same time, if you were to have more shares, maybe, and it would go out more towards $802, might be something for you to think about. So you're always constantly trying to think of when you can buy, when it's lesser than this, or when it's, I said that wrong, when it's at least like this and it can make those jumps. So you're analyzing, as a lot of you do, how much did it do? And now a lot of the papers do it for you. The web pages do it for you. You can just put in Yahoo Finance stock, and it'll show you what it's done. It'll give you a graph over 5 years, and it doesn't guarantee. It just shows you what it does, and supposedly that's supposed to help you know whether it's more volatile. This is just the second part. Thanks for watching. Wait for us for part 3.